Good afternoon, everyone, and thank you for joining us today. We will go ahead and get started. My name is Rokas Beresniovas. I'm with Montgomery County Green Bank. I have a couple of my colleagues here as well, Steve Morrell and Cindy McCabe. And we also have a guest speaker from Montgomery County Department of Environmental Protection, Emily Curley. If you have any questions throughout the webinar, please feel free to put them in the chat and we will answer them at the end. So with that, I will have Steve kick us off.
Great, thank you, Rokas, and thank you everybody for joining. Like Rokas said, my name is Steve Morrell. I'm the Chief Investment Officer at the Green Bank. It's a real pleasure to do this webinar focused on capital providers because as you'll hear more about, we work very closely with a lot of capital providers in the county and around the county, and really looking forward to getting you more information and figuring out best ways to collaborate. So Rokas put up the agenda here. Just want to spend a brief minute for those who are new to the topic. I want to tell you a little bit about what green banks are and who we are as the Montgomery County Green Bank, and then dive right into our commercial products. As you saw from the invite that Rokas sent around, a lot of the focus here is on commercial lending and partnerships with the Green Bank. And so we want to just really focus in on what those commercial products are and ways to collaborate, and really then hit what the benefits are of working with us, with the Green Bank. And we have a case study that kind of talks about some of those benefits. And then, like Rokas mentioned, we're fortunate to be joined by Emily Curley from the county to talk a little bit on a legislative update and really what we're looking at in terms of market growth, and really why you should listen intently on how to participate and work with the Green Bank. So let's go ahead and get started. Like Rokas said, if you have any questions, feel free to throw them in the chat. Q&A, we'll have some time at the end to also talk through. So if you go to the next slide, Rokas. If it's working. Just want to spend a minute talking about what green banks are. And there we go. And really for all of you who are new to the Green Bank, what it's about is really enhancing the ecosystem for clean energy investing. And we do that in a variety of different ways. Green banks are all mission-driven institutions. We're all focused on climate and clean energy investment. And so we at the Montgomery County Green Bank have a particular geographic focus to those type of activities in the county. And we do that through a couple different ways. We work to build the clean energy market through educational resources, through other ways that we work with end users and property managers and property owners and residents to really build the exosphere for clean energy investing. We do this to meet county goals, and other green banks meet state goals or national goals even. There are national green banks out there. And we do that by leveraging public funds. So really our focus is to catalyze investment and bring in more funds and really bring build the ecosphere to do more and more climate investing. If you go to the next slide, Rokas. There are green banks all around the US. We're not the only one. We were the first county level one established, but there are state level green banks throughout the US, and there's a green bank in the district itself. And they're popping up all over the US every day. So it's a great development in terms of catalyzing clean energy investment, and really for all the capital providers that are on that have a footprint in other markets. What you learn here today can be helpful with other green banks. We're all different entities, but we all do similar activities. Go to the next slide. So specifically in Montgomery County, we were chartered by the county, again, chartered as an independent entity, but chartered in order to achieve the climate goals of the county. And so we're actually a 501c3 nonprofit. We're like a financial intermediary. We're not a real bank in that we're taking deposits, but we are a financial intermediary and a commercial lender in that we work to get out commercial loans to help the market. So we were originally capitalized with 18 million in capital from a Pepto Epsilon merger. And then just as of 2 days ago, the county council passed an appropriation for an annual funding base from the county energy tax proceeds. 10% of that will go on an annual basis to the Green Bank. This year, that is roughly $17.5 million. And it's really going to propel the type of activities we do and the type of relationships that we get to grow with capital partners. And so everything that we do is meant to accelerate investment and crowd in commercial investment. So all of the types of investments we do, we work with capital partners, capital providers, which are why you're on the panel today. We're not looking to displace the market and do loans ourselves, separate from what you all are doing. We're looking for best ways to work together. And as a result, we tend to bring in private capital and we aim for leverage at a 4-to-1 ratio. In other words, we take public funds and for every dollar we bring in, we're looking to bring in, really it's 3 to 4, but sometimes we're even greater than that, $4 of commercial capital to go alongside that public capital. So we've got a set of commercial products. It's a commercial product suite that we call it. And really, again, these are just relationships that we have with capital providers. First off, we're the administrator of the Commercial PACE program for the county. We work very closely with DEP, who's on the phone, as well as the county finance group in order to get CPACE transactions through the gate and then servicing that portfolio as well. And I'll talk a little bit more about what CPACE is, but that's open to any capital provider that's interested in CPACE. We're not a capital provider for that one, we're the administrator. In place of CPACE, in other words, in a position to be able to fill a gap that CPACE cannot, we have the Commercial Loan for Energy Efficiency and Renewables, or CLEAR, what we talk about. And CLEAR is a loss reserve that we set aside to help from a credit enhancement perspective for capital providers. And so I'll get into a little bit more about when that's useful, but those two together are real companions about the way to deliver clean energy investing to the county. And then the last is tailored structured debt. We really work on a tailored basis as well in terms of how we can get out unique structures, portfolio structures, syndications or participations, bridge loans. We really try and be flexible to meet the market where it needs to be. So the type of partners we work with are really any partner that wants to work with us. And so we work with credit unions, we work with community banks, and for the most part, I'm talking about a lot of the regional banks within the DC metro area. We work with some national partners as well. We work with CDFIs. So it's an open market really to work with us through these products. So I'll take a step through some of how these products work. And then of course, look forward to getting more questions as we go through. But starting with Commercial PACE, Commercial Property Assessed Clean Energy is a financing tool unique around the US in order to catalyze energy efficiency and renewable energy upgrades. In some areas, it's even used for climate resilience. And so if you think of the types of investments being made to make a property resilient to various climate events, then CPACE can be used for that as well. So it's a program that's initially offered at the state level or authorized at the state level, and we have it in Montgomery County as administered through the county, and then we're the program manager for it. It's a type of loan that's secured by the property, but at a super senior level. It's repaid by the property tax bill. So for a property that has a CPACE loan, when they get their property tax bill, there will be a line item, an assessment for CPACE repayment. For capital providers that are looking to participate in the CPACE program, that's super senior security. And so for a lot of partners around the US, and we see CPACE financing growing very rapidly, that's our particular interest to have that kind of security behind a property. And so it's used to finance up to 100% of project proceeds. Those are hard and soft costs of a project and terms out to 20 years. And so for a borrower's perspective, that's a phenomenal idea to have potentially 20 years of fixed rate financing that can cover 100% of a clean energy efficiency project. And so it's a really win-win from a borrower and a capital provider perspective. Like I mentioned before, we're not the capital provider for that, we're the administrator. So we're looking to work with any capital provider that wants to be a CPACE provider. Again, specific to CPACE, there's legislation all around the US and very active programs all around the US. And so if your footprint is larger than Montgomery County or even the DC metro area, there's other areas that CPACE is very active, and it's growing very rapidly. It's already billions of dollars which have been catalyzed under CPACE financing, and the Commercial PACE program in particular is really building up around the US. There are some jurisdictions that are shown here that are residential PACE. Residential PACE doesn't exist in Maryland, and so not really for us in Montgomery County, but it's exclusive to commercial PACE, which is also growing pretty rapidly. Go to the next slide. Oh, wonderful. We have a poll. So first poll is up. Have you heard of CPACE before? And so please take a moment and answer the poll to the best that you can. I think it's a fairly straightforward question, so we should have a good response rate to that. And we can make sure that we understand whether we're really talking to your interests and talking to what people know about particular programs. So what comes under CPACE? A whole variety of eligible activities. We look at retrofits and we look at new construction. Okay, we've got the results of the poll, so I'll stop for a second. So looks like the majority have heard of CPACE, but there are actually quite a few who have not. So that's great that we have some people that are new to commercial PACE. Like I mentioned, it should be particularly attractive for a lot of capital providers that are looking for that super senior position, security of being part of the tax assessment. And so I definitely recommend people pay close attention to that. Sorry, the lights went off in my office. There we go. And so getting back to the slide here, a couple different eligible activities. CPACE is available for retrofits and CPACE is available for new construction and rehabilitation. So on retrofits, hard and soft costs of a project that you're looking at, up to 100% of project costs can be approved under that. The CPACE assessment itself can go up to 20% of a maximum on the LTV of a property, but a property can have 90% as a maximum of the total debt to value. And so that could include a mortgage on there, that could include other types of lending, inclusive of the CPACE loan itself, going up to 90% maximum debt to value. There is in fact legislation that's been introduced recently as under consideration by the county council to bring that LTV ratio from 20% for the CPACE assessment up to 30%. And so that would actually provide a lot of flexibility to grow those project sizes if that passes, which we hope will happen relatively soon. New construction and rehab. And I'm going to talk a little bit more about this because I think it's kind of a real unique feature of CPACE that should be particularly attractive to developers. But again, this is for projects that are doing a complete gut rehab or a new construction from ground up. It's for project scope that meets or exceeds the energy performance required by the county building code. The county, Montgomery County, has what I would call an aggressive or one of the later versions of the construction code for permitting purposes. It looks at energy systems across everything in new construction. So in order to get a permit, you're already building an energy model in order to be compliant with that code. Share that energy model with a CPACE provider, or if you're the CPACE provider working with a developer, encourage them to share that with you, because that really opens the window to use CPACE with respect to those energy elements. And you have an energy model, you can just take a look at where the performance of the building is going to be. And so if you are exceeding that energy code by up to 5%, that opens a window of 15% LTV for CPACE. And if you're greater than that, 20% LTV. Again, the legislation that's in front of the county council right now will actually increase those amounts. So those project sizes could get even higher. But again, it's all in relation to the code, and you're already taking a look for new developments at that energy model. And the last piece that's highlighted here is power purchase agreements. And this is kind of a unique feature that not everybody thinks about, but a power purchase agreement, it's a third-party solar agreement or a third-party renewables agreement, can be PACE secured. So the type of payments that come in under a PPA can effectively be secured by PACE. Again, a PPA is basically a loan under a different name, secured in a different way, and paid for based on the power produced as opposed to an amortization schedule, but that can be PACE secured. So a lot of great eligible activities that can come under CPACE. If you want to go to the next slide. So like I mentioned, I was going to come back to CPACE for new construction. I find this fascinating as a finance person, and I think you all will as well. This is really attractive to those developers that are out there thinking about what their capital stack looks like for development. And if you think from a traditional perspective of somebody getting roughly 65% on traditional debt for a new construction, and they're putting in 15 to 20% of their own equity, there's a gap in there. And there's a gap that's typically filled with mezzanine finance. Mezzanine finance tends to be relatively expensive, not as expensive as the equity that's being put in, but a lot more expensive than debt levels. And so if you can replace that mezzanine, you as a developer can replace that mezzanine finance with PACE at a long-term fixed low rate for 20 years, it's out there, that's going to be significantly lower than the mezz financing rate. So your overall weighted average cost of capital will drop dramatically. And for developments that are building new buildings, doing gut rehabs, that's millions of dollars. So it's not really like a large difference in type of financing mechanism just to save a couple dollars. We're talking about millions of dollars by inserting PACE instead of a mezzanine finance into the capital stack. So really encourage you to work with all of your customers on showing the value of CPACE for new construction with developers. And we're always happy to kind of work through those numbers with you on any case-by-case basis. So we work with a lot of partners currently. The Montgomery County is an open market. And so we can work with any capital provider that really meets the qualifications to become a CPACE capital provider. And we have some great ones that we work with currently. Greenworks Lending from Nuveen. And I actually think that they may have changed their name again recently. If there are any Nuveen folks on, they can correct me. And there's a different name now, but it's used to be Greenworks Lending. They joined with Nuveen, and now I think it's Nuveen Clean Energy or something similar. Forbright also, who went through a name change recently, that used to be Congressional Bank, Capital Bank, and Bayview, who we also work with, great partners, and Y Green, one of our recent partners as well. So if you are a new capital provider and interested in joining, please just reach out at any time. Rokas can help you with that. And we are looking for more and more providers all the time to join. Like I said at the beginning of the presentation, CPACE is not always right for every transaction. There may be a senior lender in that capital stack that's not willing to consent to CPACE that would come pari passu with taxes. And so if the first lien is already with somebody else and that's not so much of an interest, we, the Green Bank, put out what we call CLEAR. And CLEAR is really meant to come in as a potential subordinate financing, but it's meant to mainly be a credit reserve, a credit enhancement to help capital providers that are taking a look at roughly the same type of projects. So, scope is pretty similar to what you saw in CPACE. We're talking about commercial properties in the county. We're talking about properties that are looking at energy efficiency and renewable energy transactions from a retrofit perspective. And it's meant to pair with an existing commercial lending practice. So what we are looking to do with CLEAR is provide a credit enhancement where you as a capital provider can really run your typical commercial lending practice and then benefit from that loss reserve, that credit enhancement that sits behind the loans that you're issuing. So we focus on energy efficiency retrofits with this product. There is a window, we call it 30% for other improvements. A lot of the times if someone's doing a retrofit, there are other things that come in. You may need to do, for example, like an asbestos abatement as part of a renovation, or new walls or other types of features. Our target is to achieve a 15% projected energy savings for a property, for a borrower. And it's not for new construction. So if you're looking at new construction, then CPACE is really the place to be at that point, and not for refi by itself. If there's a smaller refi as part of a CLEAR loan, then clearly that's important. Maybe you need to pay off a mortgage to really get a new bank involved. But just going back up to the second bullet point here on our target to achieve 15% projected energy savings, this gets back to what we do as a Green Bank and a lot of the outreach that we do directly with potential borrowers and end users. And that is to prove the value proposition of clean energy and energy efficiency, to demonstrate that these folks are going to get energy savings. They're also going to get operational savings. And ultimately, from your perspective, that means free cash flow to be able to support project repayment, as well as potentially open up cash flow for other types of activities that property is doing. So we find that all of the energy efficiency investments and all of the clean energy investments that we promote end up being actually accretive to the property and end up opening cash flow over the long run for other types of debt repayment, other types of activity. So it really hits the hammer of why this could be a benefit to capital providers as well to really generate that value. And that's not easy to think about from an end user or borrower's perspective. They have other businesses that they're running, they have other things to do, and that's why we're here to help with that. So part of the CLEAR program is this educational element of getting involved with those borrowers and helping them understand the value. If you want to head to the next slide, Rokas. Like I mentioned before, the property types. Let's stop for another poll. This is great. I appreciate that Rokas and Cindy are getting up these polls, and glad that everybody can participate. So if you can take a moment and let us know if you've heard of CLEAR before. I understand that this is a little probably more specific to green banks, that if you weren't familiar with green banks, you probably had not heard of CLEAR before, but we'll see what people say. Again, just appreciate the fact that we're really figuring out what's most useful for you to know. This is fairly bit of a high overview that we're going to go through, and we can dive down into any kind of details. And so it looks like, actually, if I recall, the exact same percentage of those who knew CPACE versus those who do not. And so that's, I think, pretty telling. And maybe it's the same people, maybe it's different, but really good to know that we're looking at roughly the same percentage. For those who are not familiar, and this has been too much of an overview, high-level overview, but you're keen on learning more, feel free to reach out to any of us at any time, and we'll leave our contact information up at the end. But very pleased that there are so many people that know the programs well. So like I was mentioning in CLEAR, a lot of the same property types, a lot of the same use of proceeds as you saw in CPACE. Really, the focus is on energy efficiency and renewable energy. The property types, though, I think are particularly interesting to think about. And we're going to hear more from Emily about how everybody in the county really needs to think about energy efficiency for their building. But there are property types that are, I think, particularly challenging, and you all can correct me if I'm wrong, but particularly challenging for traditional commercial lenders. If you think of faith-based institutions and other nonprofits, if you think about condo buildings and condo associations or other nonprofits, those can be a challenge as a property type. You're not always going to be able to get a first lien. You're not always going to have a great financial assessment from reserves or other types of equity that's already into a transaction. And you may not necessarily see a positive net income history, especially given the pandemic. And so CLEAR is really meant to kind of step up as a credit enhancement in those circumstances where you may see those the benefit of having somebody stand behind a loan that you would issue to that property type. So as the diagram shows here, it's meant to be a credit reserve. We stand behind with a loss reserve for the bank, for the lender that's participating in CLEAR, and then the lender is issuing loans to borrowers specifically. So it's not a green bank loan that's getting out directly to the borrower. It's meant to enhance your practice. It's your loan out to the borrower. Collateral is held with you as the capital provider, and we stand behind that with a loss reserve. So, we look to stand behind with a loss reserve. An example of one that you can take a look at, if you think of originations on an annual basis of $10 million, we could stand behind that with a loss reserve of 5%. A lot of these values here are meant to be representative of something that's an improvement upon your current portfolio management practices. So if you think of your portfolio and lending in the commercial space, and there are certain non-performing loan percentages, maybe it's 2%, maybe it's 3%, we want to take a look at a loss reserve that's 5%, something that's going to be an improvement upon the NPLs that you're seeing otherwise. So on a portfolio basis, there's a value that you can get from a credit perspective of understanding that you'll have more coverage over what you would normally see as potential losses. And then within each individual loan and in each individual loss, to have 80% guaranteed up to whatever amount is in the loss reserve. So it is a little bit similar to what you would see from an SBA program from the perspective of standing behind potential losses on a portfolio basis. So for those of you that are familiar with SBA lending, there is a lot of analogy to the CLEAR program. And then finally on the terms, we look to see people issue loans out to 12 years. Again, 12 years is meant to be an improvement. If otherwise you would have been stuck looking at 5 years or 7 years or 10 years, it's a value to the borrower to look at that longer tenor. And if we're standing behind the loan, then it should have the credit support for you to be able to think about going longer. And again, 100% financing. So here we look to be able to support security that's secured by the project, not necessarily the property. If you have the ability to get the first, or you have an ability to get a super senior loan with CPACE, that may be a good route to go out 20 years from the borrower's perspective. But we want to be able to provide some enhancements that you can secure through, say, UCC1 statements, second positions, through a blanket lien or other types of security that you can put behind a project. I'm going to head to the next slide, Rokas. So like I mentioned, clear what's behind it is a loss reserve agreement. And so we enter into a loss reserve agreement with a specific lender. We set aside the funds for that loss reserve that sit in a depository account. It can sit with your institution, and it's meant to sit as restricted capital. And we prove that, we show that through our financial statements each month, so you know what's out there in terms of the loss reserve. And so it's restricted, it's specific to a lender, it's not pooled. So you're not looking at a loss reserve that's pooled with all of the capital providers. You have a specific loss reserve for you as a capital provider, as a single institution. We provide a report of what that balance is. You provide us a report of how your portfolio is aging. So we understand as loans amortize, what is needed in a loss reserve, as you originate new loans, how to add to that loss reserve. It's a bit of a balance game, so we do frequent reporting to make sure that we have the right balances under there. And then the loss reserve is just available on any delinquencies. So we say if you're looking at a delinquency beyond 90 days, you can make a call at that 80% of a single loss. Recoveries are meant to come back to you if you're made whole, to replenish any payouts from that loss reserve. So if you do end up getting a full recovery, you can actually replenish the loss reserve and utilize it for other loans. And so the reserve itself grows and shrinks in line with the agreement and what gets originated under the pool, again, for your specific institution. Going to head to the next one. We currently work with a couple different providers, Sandy Spring Bank, who's been a wonderful partner, same with LEDC, under this clear loss reserve. And we're working with others as well who are actually in the process of joining, and really appreciate their dedication to this market and the value that they're seeing. Capital Bank as well as M&T Bank, who have been great in terms of walking through this process. I'm going to head to the next slide. So the third leg of the stool that I was mentioning on the commercial products are these structured debt, or these tailored products. And really, this is a way to think about growing with participations. With the market needs that we're going to talk about, and Emily's going to hit a little bit more, the county is very aggressive on its climate action goals, which is fantastic for all the residents of the county. And what that means is that the property owners, particularly on the commercial side, really need to think about energy performance. And thinking about energy performance means thinking about retrofits, thinking about other types of clean energy measures that can be implemented, which of course has investment capital that's needed. The Green Bank capital base is growing actually very quickly. As I mentioned, just as of 2 days ago, the County Council gave us a capital infusion and have real high expectations of how we can accelerate the market with it. And so we're looking to really deploy that capital, and participations are a great way that we can actually continue to work together. And there's other benefits that can be made on the back end to those borrowers. So the fourth point here, borrowers are really sensitive to the cost of capital. We as the Green Bank have a particular catalytic focus with our cost of capital, as opposed to a pricing model and a reserve model that we have to follow. And so we back into blended capital rates. And so a borrower that's taking a look at a loan that has a participation with the Green Bank could see a note rate that ends up lower than what they would have seen from that institution otherwise. We really target to bring that rate down for them, as they're sensitive to the cost of capital. It helps them get more projects done. We have the flexibility to do it. So growing with us through participations is a real great way to do that. Another thing that you may encounter is, transactions and generally an entire portfolio could really hit your concentration or your legal lending limits. And so doing a participation with us, doing a participation that we can syndicate out as well, really helps that legal lending limit. And so we think as this market is growing, and it's going to be growing rapidly, more people may hit that limit. And so thinking about working not just through Clear, but with participations with us is a great way to hit that. As I mentioned before, more property types as well are trying to get in this space, and you may not want to risk exposure for a particular property type up to the level of a project. So we work with a lot of partners on this tailored style of product, and we can really, like I said, work with anybody. Sandy Springbank has been great as a partner there. City First Enterprises, who's a CDFI, has been another great partner who we have a very strong tailored structured relationship for both small business relationships as well as larger projects. Skyview Ventures and Sunlight General Capital are two that focus quite a bit on renewable energy. We do solar projects with them. We look at power purchase agreements, which, like I said, are loans under a different name and a different structure. And then, of course, we have financial partners that we're working with on these structures as well. Capital Bank, NCB, M&T have been great, kind of thinking on specific transactions as well as the partnership overall. So, let's stop for another poll. This is great. So this is actually also really helpful. If you could respond here, what we're really keen to know is what size of transactions do you take a look at in the commercial market in Montgomery County? Again, for us to know really what you as a capital provider, your ticket size, your appetite is, then we can really think and work to marry up the borrowers that we're talking to and all the folks that we work with in terms of what is your specific focus. We get a lot of borrowers that approach us directly. We get a lot of borrowers that come to us after we deliver educational resources like webinars and other types of activities. So knowing what your interests are means that we can just pair up people the best through that kind of relationship. And so if you're a relationship manager, even if you're an underwriter, but if you're really on the forefront of the market, thinking, let's stop for a second, take a look at this. So this is great. So it looks like there aren't so many people that are stuck really at that 250,000 limit. People are either above or quite above on $1 million. And this is good to see. As I mentioned, and Emily's going to hit more, the market is growing rapidly, and really the size and the need for a lot of transactions are going to grow. And there's going to be quite a bit of opportunity for those size transactions and higher. And so like I was starting to say, for those thinking about what do I do if I'm on the forefront of the market, really all the simple way you need to think about it is a potential loan that you're looking at energy related. And from a new construction perspective, you could think about that energy model that's being built. From a retrofit perspective, you could think, are they improving any type of energy system, the HVAC, the windows, the building envelope, the insulation in either the roofing or the walls? Are they putting on solar? Is there some kind of energy relation to what you're looking at? And then you may be faced with two questions. Either you need competitive terms because it's a borrower that is competing across different capital providers and they're really looking for the best rate, or you need a credit boost because it's not really a borrower that would easily be approved under your system. Those are both reasons to think about working with the Green Bank through our Clear program, through our structured participations, or maybe even to be a CPACE capital provider that you can work with us as administrator on. So any type of those energy related questions, if you want to think about a competitive rate, if you want to think about a credit boost, come to the Green Bank and we can talk about the transaction you're working on. I'm going to head to the next slide. There are quite a few benefits of being a capital provider. This is actually a campaign that we ran through social media recently that was great. A lot of people got to see kind of what are some of the keys of becoming a capital provider through any of our programs. And we list them out here, but there are plenty more. Market growth is going to be the key. There's a huge market growth. We're going to be on the front lines of that, looking to deploy a lot of the capital that we have, looking to do more educational events, more outreach and direct business development. And we want to get that benefit to you all as capital providers as well. Credit enhancement through our CLEAR program is clearly a way that you can get to borrowers that you may otherwise have a challenge with. Contractor peace of mind, I think, is pretty important. We work with contractors, energy performance contractors that have been part of Empower Maryland's utility incentive program. And so they are trained to focus on these type of energy efficiency, clean energy upgrades. And they know what type of incentives and grants are out there. And so there's a lot of quality assurance that comes with that. Recognition, we want to publicize everything that you're doing and everything that we can help with. And so getting you as much publicity as we can in this market is beneficial, not just for you deploying capital and getting projects done, but for people to recognize you all as clean energy leaders as well, which we think is probably important, and we can help you get there. If you head to the next slide. Our publicity is growing, and like I said, we want to share that with you. If you didn't get a chance to take a look at the Washington Post article fairly recently, this was on January 1st. It's still out there. It was a lead section on the Metro section. Definitely recommend you take a look at it. And it's actually going to, it talks about one of the case studies that I'm going to hit here. So if you want to zoom ahead to the next one, and this is a project called Tacoma Overlook. This is a great project that we did with Sandy Spring Bank as the capital provider on that. It is a condo association looking at property upgrades. And it was a condo association that was looking at property upgrades from the lens of being capital constrained. It's a real challenge in some cases for these condo associations to think about using limited reserves in executing projects that ultimately will save them money from an operational standpoint, from an energy savings standpoint. They just can't get there. And so Sandy Spring really stepped up, providing a large CLEAR loan that was backed by us. We actually provided a bridge loan to bridge an equity obligation behind it. And that was an example of us as an ability to have an ability to be flexible in terms of the types of loans that people are taking a look at. So when this particular condo association was originally looking at a $1.5 million total bill, they just kind of had to roll their eyes and say, this is something we can't do at all. That's way beyond our reserve level. We can't increase assessments because the condo association wouldn't go for it. But the Green Bank standing behind Sandy Spring was able to come in with a large loan. We were able to bridge the equity gap. It was a property sale within the property with City First Enterprises as a partner on that. And then the energy performance contractor that we worked with brought in a grant, brought in incentives from Pepco, and ultimately the condo only had to use around $200,000 worth of its reserves. So it's really an important lesson, I'd say, for these types of properties that are thinking about what resources do they have out there to be able to implement these types of projects. And ultimately, over the long run, they'll now get substantial energy savings. These guys, in fact, are going to be generating some of their own electricity as well off of waste heat. And so they have really a unique and interesting approach as well that they're applying to their own specific circumstances. And I think that is it for me in terms of slides. So like I said, I'm going to turn this over to Emily. We'll stick around after for questions and such, but Emily, feel free to take it away.
Thanks, Steve. So my name is Emily Curley. I'm the Commercial Energy Program Manager with Montgomery County's Department of Environmental Protection. And I'm told just before I jump in, there may be a poll to kick us off on my section. Here we go. Yeah, great question to see how much customer base we have within the county represented here. Great. Looks like 100%. So we're talking to the right people. That's great information. All right. So great overview, Steve. I just want to put a few of these things in context with our larger county climate goals, and then some coming regulation and legislation that is really going to, we think, really accelerate people's need for these kind of programs. So you heard Steve mention that Montgomery County has pretty aggressive climate goals. In 2017, our county council unanimously passed a resolution declaring a climate emergency. And at that point, our greenhouse gas emissions reductions goals were accelerated to 80% by 2027 and 100% by 2035. So these, ambitious goals, they're some of the most ambitious in the country. So to that end, looking at just where these emissions come from in the county, our community-wide greenhouse gas emissions inventory shows that about 50% of these emissions come from the building sector. So you can see that's about evenly split between residential buildings and commercial buildings. Multifamily buildings somewhat span those two depending on how they're metered. So one of the big activities in our climate action plan is really looking to employ policies that start to address the emissions in especially existing commercial and multifamily buildings. And one of the main goals is improving that performance through energy efficiency and other on-site efforts. So also, as you heard, the county's been working on kind of helping the sector along through things like extra financing or extra funding for the Green Bank, also the CPACE program, expanding that a bit to allow for additional activities. But we're now looking to pair some of those support programs with what you could a little bit view as the stick or the requirement behind that. And so one of the policies we're considering, they're called Building Energy Performance Standards. We refer to those as BEPS. And it's a policy that sets a minimum energy performance threshold for existing buildings. So this would address a large amount of emissions from commercial and multifamily buildings. And I'll get into how that works. If you want to go to the next slide, Rokas. Okay, so just as another bit of background, the county has had an energy benchmarking law since 2014, and this is really a foundational policy. And what it requires is today, building non-residential buildings that are 50,000 square feet and greater, they have to collect their energy data, they have to benchmark it in a tool called Energy Star Portfolio Manager, and they have to submit it to the county by June 1st of each year. There's also a data verification requirement. So today, this is simply a reporting requirement. It's not that big of a lift, frankly, to gather and report this information, but it does provide a lot of foundation for what we're trying to do, gives us the data we need to spring off of to start to address emissions in this sector. So today we have about 800 buildings covered by the benchmarking law. That represents about 40% of the county's total commercial building area. Next slide. So what we have proposed through a new bill called, not particularly new, but still under consideration bill, Bill 1621, is to amend our existing benchmarking law to really do two things. The first is to cover additional properties under the benchmarking law. And so we would do that by dropping the square footage threshold from 50,000 square feet down to 25,000 square feet, and then also adding some other buildings that were previously exempt. And the big one there is multifamily buildings. That's going to add the vast majority of our new covered building area. So with this addition, we'll ultimately be covering about 1,900 buildings, or roughly 80% of the county's commercial building area. Focusing on these larger buildings means we're capturing a large footprint of the commercial area. So the second thing, and the one that's most important, is that phasing in building energy performance standards. This goes beyond just a reporting requirement. And actually establishes site energy use intensity standards, or energy use per square foot standards, that buildings have to meet over time. So some buildings may already be particularly efficient. They don't need any financing or projects to move the needle. But frankly, most buildings will likely have to do something in order to become more efficient and meet these targets. Next slide. So just a quick snapshot on what this looks like. The idea is that buildings that are new to benchmarking would benchmark for 3 years, and then they receive a baseline. So that's those 3 dots on the left for 3 different buildings for where they're starting. Each building is given a final standard target, a final site energy use intensity target based on the type of building that they are. And then there's 2 interim checkpoints to just see if they're on track to meet those reductions. So I think just the important thing to note here is that even for buildings that aren't benchmarking today, they can certainly get started. And we're hoping that by, doing outreach about this coming legislation, that we're hopeful that County Council will be passing within the next, call it 6 months, this calendar year. But buildings that are more efficient today will have to do less ultimately. So they may start at the bottom dot and have smaller savings to find, whereas buildings that are kind of putting their head in the sand doing nothing will ultimately still have to come up with energy reductions and start moving the needle on that. So just to note that this will, if adopted as proposed, end up covering a very large amount of the county's commercial building area, and is really going to, we think, start making building owners pay attention and reaching out to folks, hopefully like you all, to start looking for ways to both finance and implement these types of saving opportunities in their buildings.
Great. Thank you, Emily. Well, we got 10 minutes left. And Cindy, do we have any questions from the chat? Oh, last poll.
Hi, Rokas. Yes, we have a couple questions. Let me just give everybody a couple more seconds to answer the poll. All right, so had anyone heard about the Green Bank before? We got a yes.
100%.
Wonderful. Thanks, everybody. So the first question is from Megan. Megan, you can feel free to unmute, but I'll go ahead and read your question. So how do we define a community bank? Question for Rokas or Steve.
Yeah, so we take a look at, like I mentioned, really any bank as a potential partner. Community banks in particular, we're looking at depository institutions that are roughly locally owned. And by local, I mean potentially regional really to the Northeast market in some instances as well. But those that can be roughly locally owned and then serving the local area. So if your question was about, what standards do we approach in terms of who we partner with, we look at community banks, national banks, and other institutions similarly, but that's how we would particularly define community banks.
Great, thank you. All right, and then we have a question from Eric. Scroll back over to it. Can the CLEAR program work together with SBA programs to further mitigate loss risk?
Yeah, so that's a good question. And I think it's a particularly good question because I don't have all the answers from SBA's perspective. From the Green Bank perspective, yes, what we do with CLEAR is we set up a loss portfolio, a loss reserve on a portfolio basis. And so the loans that you're originating in that portfolio could have different structures. The question is, from an SBA's perspective, how they would take a look at having that portfolio-wide guarantee sitting behind a loan that you're then going to originate using the SBA guarantee or an SBA loan. And like I said, I think those are kind of specific to the unique circumstances of that loan. But from the perspective of the Green Bank, yes, CLEAR can work with together with what you're looking at under SBA.
Thank you, Steve. And Emily, the next question is for you. Looking for an update. This is Sandy Barrier. Hi, Sandy. Looking for an update on BEPS legislation. Any idea of when this might be passed within the county? Oh, it looks like you're typing an answer. Sorry.
Oh, that's fine. I can just answer live. Yeah, I wish I had 100% certainty on that, which I don't. What I can say is that there will be likely one more Transportation and Environment Committee work session before this moves to full council for consideration. This is a pretty complex bill, a lot of implications for the building community, and frankly, a lot of ins and outs. So we're hopeful that once it reaches the full committee, it'll go relatively quickly, but I can't really commit to a timetable at this point. Just that, it's proposed, it's being considered, and, we are hopeful that within the next year, this will be, at least the framework legislation will be passed.
Thanks, Emily. We did have a couple questions. If the slides will be sent out, Rokas, I don't know if you wanted to do that for everyone or just for those that are looking for it.
Yes, I will send out the slides afterwards. Yeah.
Okay, great. Those are all the questions I see. And will you send out the recording as well, Rokas, I assume?
Yes, will be available.
Wonderful.
So if I could just say a closing comment quickly, and I think it gets to the questions of is the recording and the slides going to be available? There's a lot that was covered under here and some relatively quickly. If you have particular interests and particular focus, especially from an underwriting perspective, really understanding the type of collateral that comes behind transactions we're looking at from a CPACE perspective versus a CLEAR perspective versus a bespoke perspective, I think those get more complicated, and I could spend all day talking about them, as I'm sure you all as well could. But please feel free to touch base with us because you may not find the answers in this presentation, but they certainly do exist, and there's certainly a good rationale to take a look at those kinds of questions. So hopefully everybody can stay in touch. Let us know what other topics you're interested in or things that you want to do a deep dive in. Very happy to answer questions at any time. Great.
Well, thank you, Steve. And with that, we're gonna go ahead and end. And again, thank you so much to everyone for participating.
Thank you. Have a good day.
Thanks, everyone.